Afternoon everyone, I am Reguma Rachel and I am here to discuss the strategy implementation together with Angelica Sevilla. What is perceptual mapping? Perceptual mapping, also known as positioning mapping, helps you analyze visually how your target market perceives your product service. A perceptual map, an example of which is shown in figure 1 below, is a simple graph with a vertical and a horizontal axis. These axes represent the dimensions that you want to analyze, and you label each with the criteria your customers use to decide whether to buy your offering. For example, imagine that your organization sells breakfast cereal. You want to know how customers perceive your cereal and how they see your competitors' cereal. You think that healthiness and the feeling of fun are dimensions that your customers use to make their purchase decision. To explore this, you would label the left side of the x-axis unhealthy and then the right side healthy. You would then label the top of the y-axis fun and the bottom boring. You would plot your cereal along with your competitors' cereals on the graph, according to what your customers say. To remind, most perceptual maps are simple, two-dimensional graphs that compare two criteria. However, some software products allow you to create more complex, multi-dimensional maps with a number of different attributes. How to use the tool? Follow the steps below to use the perceptual mapping tool. Step 1. Determine what you want to measure. Before you create your map, it's important to understand the attributes that your target customers use to make a purchasing decision so that you can measure what's important to them. You need to understand the questions that they ask, sometimes subconsciously, when they compare your product with your competitors' offerings. To determine this, conduct appropriate market research, perhaps by using focus groups to identify the dimensions that people think are important. Then decide which dimensions you want to represent on your map. Step 2. Survey your customers next. You need to find out how your product and how competing your product rank on the dimensions that you decided to measure. The simplest way to do this is to use a survey to ask your customers to rate the products. Ask them to score your product and other products based on your pre-chosen dimensions with a number between, say, -5 and +5. Step 3. Plot the results. Once you have surveyed your customers, you can create your map. Download our worksheet or draw a simple grid with an x-axis and a y-axis. Step 4. Analyze your map. Look carefully at where you have positioned the products on the map. Consider the following questions. Does your product have a distinct, attractive position compared with its competitors? If there is an overlap, your customers might not understand your product's unique selling proposition. Conduct a USP analysis and make sure that your marketing and communication efforts highlight the product's uniqueness. If you measured your product against another product offered by your organization, does each have its own distinct space? If your company's products overlap, you might have too many similar offerings for any one of them to succeed fully. Do your customers view your product positively or negatively? Does its current position fit with your organization's marketing strategy? Next, determine where you want your product to be. What changes must you make to get this result? How can you change your customers' attitudes? Are there any market gaps that your organization can take advantage of? You might find that large sections or even entire quadrants of the market are vacant, depending on your industry and on the attributes that you explored. These vacant spaces could indicate a significant market opportunity for your organization. You can use perceptual maps, also known as positioning maps, to look at how your target market perceives your product or service. A perceptual map is a simple graph with a vertical and horizontal axis representing the dimensions you want to measure. You label each axis with an attribute that your customers use to evaluate your product before they buy it. To use perceptual mapping, run a focus group with your customers to find out what criteria they use when they compare your product with your competitor's product. For instance, healthy, unhealthy, stylish, utilitarian, sporty, family-oriented. Then, survey them to understand their perceptions and plot the results on your map. Take time to analyze the results. Gaps in the grid could indicate new market opportunities, while heavily clustered quadrants could indicate that you need to work on communicating your product's USP. Develop effective perceptual maps to identify market segments and demand voids. Competitive perceptual positioning and perceptual mapping. Perceptual maps helps marketers understand where the consumer ranks their company in terms of characteristics and comparison to competing companies. When creating a new product, a company should look for a space that is currently unoccupied by competitors and that has a high concentration of consumer desire. Also, a perceptual map is usually based more on a marketer's knowledge of an industry than market research. Terms: price elasticity, the measurement of how changing one economic variable affects others. For example, if I lower the price of my product, how much more will I sell? If I raise the price, how much less will I sell? If we learn that a resource is becoming scarce, will people scramble to acquire it? Demand void, areas without any significant consumer desires typically found in ideal point maps of perceptual mapping. Perceptual mapping is a diagrammatic technique used by marketers in an attempt to visually display the perceptions of customers or potential customers. Typically, the position of a product line, brand, or company is displayed relative to their competition. Some perceptual maps use different size circles to indicate the sales, volume, or market share of the various competing products. Perceptual map of competing products. Perceptual maps commonly have two dimensions even though they are capable of having several. For example, in this perceptual map, you can see consumer perceptions of various automobiles on the two dimensions of sportiness or conservative and classy or affordable. The sample of consumers felt that Porsche cars were the sportiest and classiest of the ones in the study. A company considering the introduction of a new model will look for an area on the map free from competitors. Perceptual map of a consumer's ideal. Many perceptual maps also display consumers' ideal points. These points reflect ideal combinations of the two product characteristics as seen by a consumer. This diagram shows a study of consumers' ideal points in the alcohol product space. Areas without ideal points, such as indicate a market segment. Areas without ideal points are sometimes referred to as demand voids, combining the competing products and ideal points map. A company considering introducing a new product will look for areas with a high density of ideal points. They will also look for areas without competitive rivals. Perceptual maps needs not come from a detailed study. There are also intuitive maps, also called judgmental maps or consensus map, that are created by the marketers based on their understanding of their industry. The value of this type of map is questionable, as they often just give the appearance of credibility to management's preconceptions. When detailed marketing research studies are done, methodological problems can arise, but at least the information is coming directly from the consumer. Determine the cash worth of any business. Determining the fair market value of a company can be a complex task. There are many factors to consider, but it's an important financial skill businesses leaders need to succeed. How to evaluate a business? One way to calculate a business valuation is to subtract liabilities from assets. However, this simple method doesn't always provide the full picture of a company's value. This is why several other methods exist. Here's a look at 6 business valuation methods that provide insight into a company's financial standing, including book value, discounted cash flow analysis, market capitalization, enterprise value, earnings, and the present value of a growing perpetuity formula. First is book value. One of the most straightforward methods of valuing a company is to calculate its book value using information from its balance sheet. To calculate book value, start by subtracting the company's liabilities from its assets to determine owner's equity. Then exclude any intangible assets. The figure you're left with represents the value of any tangible assets the company owns. Second is discounted cash flows. Another method of valuing a company is with discounted cash flows. This technique is highlighted in the Leading with Finance as the gold standard of valuation. Discounted cash flow analysis is the process of estimating the value of company or investment based on the money or cash flows it's expected to generate in the future. It also calculates the present value of future cash flows based on the discount rate and the time period of analysis. Third is market capitalization. Market capitalization is one of the simplest measures of a publicly traded company's value. It's calculated by multiplying the total number of shares by the current share price. Fourth is enterprise value. The enterprise value is calculated by combining a company's debt and equity and then subtracting the amount of cash not used to fund business operations. Target market. A target market is a select group of potential or current consumers which a business decides to aim its marketing and advertising strategies at in order to sell a product or service. Researching, identifying, and qualifying a target market is one of the first steps in developing a coherent marketing strategy. For example, in the case of curved barge bench, while the image was taken in Japan, the bench appeals to far more people around the globe than the Japanese. Last is positioning. Positioning strategies are generally used to differentiate the brand from its competitors. However, the positioning strategy needs to be flexible so it can adapt to changes in the external environment. Using a unique brand name that reflects the vision and objectives of the business will allow for a superior competitive position. This will help businesses secure financial returns from the targeted market. The three techniques used in positioning include brand, product, and price. The combination of these will contribute to a successful positioning strategy. That's all. Thank you.
Discuss procedures determining the worth of a business. Business evaluation, also known as a company valuation, is the process of determining the economic value of a business. During the valuation process, all areas of a business are analyzed to determine its worth and the worth of its department of units. A company valuation can be used to determine the fair value of a business for a variety of reasons, including sale value, establishing partner ownership, taxation, and even divorce proceedings. Owners will often turn to professional business evaluation for an objective estimate of the value of the business. Key takeaways: business valuation determines the economic value of a business or business unit. Business valuation can be used to determine the fair value of a business for a variety of reasons, including sale value, establishing partner ownership, taxation, and even divorce proceedings. Several methods of valuing a business exist, such as looking at its market cap, earnings multipliers, or book value, among others. The basics of business valuation. The topic of business valuation is frequently discussed in corporate finance. Business valuation is typically conducted when a company is looking to sell all or portion for its operation or looking to merge with or acquire another company. The valuation of a business is the process of determining the current worth of business using objective measures and evaluating aspects of the business. A business valuation might include an analysis of the company's management, its capital structure, its future earnings prospects, or the market value of its assets. The tools used for valuation can vary among evaluators, businesses, and industries. Common approach to business valuation include a review of financial statements, discounting cash flow models, and similar company comparisons. Valuation is also important for tax reporting. The Internal Revenue Service, or IRS, requires that a business is valued based on its fair market value. Some tax-related events, such as sale, purchase, or gifting of shares of a company, will be taxed depending on valuation. Asset method. This method is simply calculated by taking the difference between business assets and liabilities. For example, if you have $100,000 in assets and $20,000 in liabilities, the value of your business is $80,000. $100,000 minus $20,000 equals $80,000. Typically, this is not the valuation method you want to use if you have a profitable going concern business. Income method. This method is a favorite for financial wizards and professors who love teaching theory. It's not easy for most small business owners to understand, let alone calculate. In short, you have to determine the business future economic benefit, forecasting financials, adjusting for growth, rates, cost structure, taxes, working capital, etc., and then discount the future economic benefit to a present value. It involves discount rates, discounted cash flow calculations, or capitalizations of earnings. Honestly, market method. Let's focus our time and effort on this method. It's quick and easy to understand, and you'll know within 5 minutes what your business is worth, or at least a general range. The basic premise is to look at what companies similar to yours in size, revenue, and other characteristics have successfully sold for. The value of your business is tied to that value. Let me give you an easy example. Once you understand the math, you can apply this to your own business. According to BizBuy Sell Data average cash flowing business sold for 2.28 minutes times seller's discretionary earnings, or tinatawag na SDE. First, let's tackle what SDE is. If your profit and loss statement shows that you have a net profit of $100,000, you need to add back a couple of items. This includes any personal discretionary and one-time expenses, as well as one owner salary. Let's assume you have a salary of $50,000 per year. Following the advice of your CPA to lower your taxable income, you use the business to pay for your family health insurance, auto, gas, and auto insurance. You also have some depreciation and interest, as well as retirement contribution. Let's assume all those expenses add up to another $50,000. Here is what the math looks like. For example, net profit $100,000, owner salary $50,000, add back expenses $50,000. This must be documented and justified. SDE $200,000, $100,000 plus $50,000 plus $50,000. Now for the valuation, SDE is $200,000. Market multiple 2.28. Fair market valuation $546,000, $200,000 times 2.28. There you have it. All you need to do to quickly determine the value of your business is to calculate SDE and multiply it by average market multiple for your industry. It's key to determine your what your market multiple is, and having access to successfully completed transactions is vital in this research. You likely need to see a business broker who has the Certified Business Intermediary, or CBI designation, or a mergers and acquisition specialist. Both of these professionals can look up the average market multiple for your industry and adjust it up or down based on the individual characteristics of your company and circumstance. A lot of training and professional standards go into determining this. So when the time is right to list and sell your business, don't rely on 2.28 just because it's the market average. Consider seeking out a professional to get detailed help. Once you know how much your company is worth, can then determine if it's time to sell your business and cash out now, or continue building for an increased future valuation. Here is the fun part. Using the example above, your business is worth $546,000, but you really want to sell it for $750. Just work the numbers backward and you'll know exactly what you have to show in annual SDE to justify a $750,000 valuation. What is the EPS and EBIT analysis? Perform EPS EBIT analysis to evaluate the attractiveness of debt versus stock a source of capital to implement strategies. EBIT EPS analysis quantifies the impact of financial decisions on per share profitability or EPS driving shareholder value. EBIT EPS or earnings before interest and taxes, earnings per share analysis is a valuable tool for understanding how different financing decisions can affect a company's profitability for shareholders. It is used in financial planning to evaluate different financing options and their impact on a company's earnings per share or EPS. How to calculate EBIT EPS? EBIT EPS calculation for debt financing involves 5 actionable steps. Let us take a look into these steps. First, determine capital requirement. Start by identifying the precise capital injection your company needs. Underestimate and you face operational bottlenecks later. Overestimate and you saddle yourself with excess debt and unnecessary interest expenses. Evaluate alternative financing options like equity, issuance, but choose the method that aligns with your projected cash flows and growth plans. Step 2. Identify your starting point or EBT or EBIT. EBIT or net operating income is the foundation for debt financing calculations. It's calculated as gross operating income, total sales, minus operating expenses, business costs. EBIT represents your underlying profit potential at unattained by any financial leverage. Step 3. Factor in debt costs. Let's factor in the cost of your debt. Multiply the loan amount by the annual interest rate to determine the annual interest expense. This is the price tag for employing borrowed funds. Subtract this expense from your EBIT to reach EBIT, earnings before taxes. EBT signifies your profit after servicing the debt burden. Step 4. Calculate after-tax earnings. The taxman looms large. Estimate your projected tax liability based on applicable tax rates. Subtract this tax bite from your EBT to arrive at EAT or earnings after taxes. EAT represents your net income reflecting the combined impact of debt, costs, and taxes on your bottom line. Step 5. Calculate EPS with outstanding shares. Finally, let's see how much of this remaining profit flows to each shareholder. Since debt financing doesn't involve issuing new shares, divide your EAT by the number of outstanding shares in your company. This magical metric, EPS or earnings per share, tells you how much profit each share translates to after considering debt and taxes. Discuss the nature and role of research and development in strategy implementation, developing new products and improving old products effectively. Applied research carries the findings of basic research to a point where they can be exploited to meet a specific need, while the development stage of research and development includes the steps necessary to bring a new modified product or process into production. Research and development or R&D is when business gather knowledge to create new products or discover new ways to improve their existing products and services. Larger companies may have their own research and development team that will test and refine products or processes before commercial use. Strategy implementation includes developing strategies supportive culture, creating an effective organizational structure, redirecting marketing efforts, preparing budgets, developing and utilizing information system, and linking employee compensation to organizational performance. Explain how management information system can determine the success of strategy implementation efforts. Management information system or MIS obtains information from the external and internal assessments of a business, collecting information in regards to marketing, finance, production, and personnel matters on the inside and information in regards to social, demographic, environmental, economic, political, governmental, legal, technological, and competitive influences on the outside. Management Information Systems or MIS obtains information from the external and assessment and internal assessments of business collecting information in regards to marketing. MIS is like the heart of business. It ensures all necessary information is collected from the numerous sources, processed and sent to the destinations needing the information or MIS. Helps with strategy implementation efforts by providing accurate and up-to-date information by conducting analytic functions. MIS that effectively work with the information formats of a company have the ability to structure a company's available data from its company operations and records into reports that are easy to follow and assist with company decisions. When a company bases their decision on the data provided by MIS, they are making decisions based on the information stemming from the operations of their company. MIS take data created by the working level and unify the data into productive formats. The final product contains sales figures, expenses, investments, and workforce information. MIS can even provide accurate reports regarding how much profit has been made by the company in the past 5 or so years in order to make better decisions for said company. Additionally, some MIS have the ability to run scenarios, which is an essential decision-making tool. Those that do not hold this feature are still able to run scenarios on other applications like spreadsheets. This particular feature allows companies to see what may happen if a particular decision is made with the company. It shows how particular variables change as you make a decision. The feature is very detailed and can show a company what will happen to revenues if staff levels are reduced or if the promotion budget is increased. MIS help to make realistic scenarios possible. Thank you for listening.